Get started in just a few seconds. Okay, good morning and welcome to the ParkBridge Wealth Management Fall Webinar Series. This program is entitled The Final Countdown 2025 Last Minute Wealth Planning Ideas. As always, my name is Jonathan Shenkman. I'm the President and Chief Investment Officer of ParkBridge Wealth Management, where I work with individuals and families to manage their investment portfolios and provide financial planning guidance. So, this is my fourth year end wealth planning webinar, so it's become somewhat of a tradition at this point. For folks who have never attended my year-end webinar before, I aim to cover a bunch of different planning ideas to help you and your clients before December 31st and beyond. I'll discuss a whole host of timely topics from investing, estate planning, tax strategies, and more. So prepare to receive a fire hose of information and have a pen and paper ready. Okay, here we go. So first, let's start with some investment ideas, in particular, some year-end investment do's and don'ts. First, do consider rebalancing your portfolio. Many parts of the market went up in 2025. However, there may be individual investments within your portfolio that went down or didn't go up as much as other areas. This may include REITs, small cap stocks, and investment grade bonds, all of which have underperformed the S&P 500 and international markets. Interestingly, international markets actually trounced the performance of the S&P 500 this year, so keep in mind that it always pays to diversify. Given these market dynamics, many investors' portfolios are probably out of whack, and it may make sense to rebalance your portfolio for a few different reasons. One, ensure that your allocation is brought back to its appropriate risk tolerance. Two, to potentially lock in some losses for tax planning purposes. And three, add the proceeds to your losing positions that may appreciate meaningfully in the future. The next point is don't chase past performance. Today and every day is a good reminder to stay away from the current hot strategy du jour. Every year, there's always some investment that did phenomenally well. Unfortunately, it's impossible to know beforehand which manager strategy or index that will be. This won't stop aggressive salesmen from capitalizing on a recent success, touting great returns and encouraging investors to invest in yesterday's winners. In particular, you see this in private credit, which has been a darling to investors for some time. However, this year, there have been many stories of private credit taking quite the beating. Remember, the market moves in cycles. One year's winners are oftentimes losers in the following years. The key is to stick with a proper asset allocation and plain vanilla investments that will allow you to achieve your goals. Chasing past performance will not work out over the long term. And here's a quick investment planning tip, which is to automate your investment process. You shouldn't have to manually move money into your investment accounts multiple times a year. I encourage all my clients to automate their deposits into their various accounts. And like all my advice to my clients, I practice what I preach and do this with my own money as well. Automation removes emotions from your investment process and works out well over time. Next idea is regarding required minimum distributions or RMDs. RMDs apply to folks who are 73 or older and to beneficiaries who inherit these accounts. If you are subject to RMDs and don't take them out before the end of the year, there will be a penalty. If you don't need your RMDs to pay your living expenses, explore other options like giving them directly to charity. And on that point, a good planning tip is to utilize qualified charitable distributions, which allows you to give up to $108,000 per individual or $216 per married couple in 2025 from your IRA directly to charity without needing to pay tax on these distributions, and they count towards your RMD. Which brings me to my next idea, which is charitable giving. When it comes to giving charity, there are a myriad of creative options this year. First, consider front loading charitable gifts. The reason for this is starting in 2026, the new tax law will set a minimum threshold that an individual taxpayer's charitable contributions must exceed in order for that taxpayer to get any tax benefit from claiming them as itemized deductions. That threshold is 0.5% of an individual taxpayer's AGI. This means that if an individual taxpayer's contribution base is $1 million and the itemized deductions, that taxpayer receives no benefit for the first $5,000 contributed to charity. Therefore, an individual taxpayer who itemizes in 2025 will generally still have their charitable contributions count beginning with the first dollar donated. For individual taxpayers for whom the 0.5% threshold is a concern, they may want to consider front loading their contributions in 2025 rather than waiting until 2026. Building on that point, consider utilizing a donor advised fund or a DAF. A DAF is an account where you could deposit assets for donation to charity over time. The donor gets an immediate tax deduction when making the contribution to the DAF and can still control the funds, how the funds are invested and distributed to charity. A DAF can be extremely useful if you hold a security with no cost basis, a highly appreciated stock, or a concentrated position. In all of these scenarios, the tax liability can be circumvented by moving that position to a DAF. DAFs are also useful when bunching your charitable contributions, which involves donating several years worth of charitable dollars all at once. Contributions to charity are only tax deductible to those who itemize the deductions. This year, the standard deduction is $15,750 for single filers and $31,500 for married couples filing jointly. To help your itemized deductions exceed the standard deduction amount, one can bunch multiple years worth of charitable donations. This allows the donor to exceed the standard deduction, take the itemized deduction, and still distribute the funds over the current and subsequent years. And here's a charitable giving planning tip, which is to donate appreciated stocks. This is especially relevant in 2025 since stocks skyrocket in many areas of the market. It may also apply if you have a concentrated stock position with large unrealized capital gains or large stock positions that you want to trim to de-risk your portfolio. For these scenarios, consider donating these highly appreciated securities directly to charity, which helps avoid paying capital gains tax. Next idea is Roth IRA conversions. This is the process of transferring retirement funds from traditional IRA, SEP, or 401k into a Roth account. Since a traditional IRA is tax deferred while a Roth is tax exempt, the deferred income taxes due will need to be paid on the converted funds at the time of conversion. There is no early withdrawal penalty for this strategy. The key is to evaluate your personal tax situation. This strategy may be beneficial if a saver believes that the postponed tax liability in the traditional account would be more onerous as retirement approaches. For example, if they think tax rates will go up, they move to a higher tax state, or if they'll be earning higher income in the future, then that all may make sense to do it. If you were laid off this year, Roth conversions may be worth considering since you may now have lower income than usual. However, be mindful that if paying the tax bill now is too burdensome, then this may not be a good option for you. And here's a planning tip to consider is to sit down with your tax advisor to determine how much income can be realized within the current tax bracket before creeping into the next bracket to assess how much in traditional retirement funds to convert to a Roth. And just a word of caution, Roth IRA conversions and a related strategy, the backdoor Roth contributions, are both popular subjects to discuss around the water cooler. Remember, just because your friends or know-it-all brother-in-law are implementing the strategy does not mean it makes sense for you. Next is beneficiary updates. Retirement accounts and insurance policies have beneficiary designations that pass outside of one's will. Therefore, even if you did estate planning, it's still important to review your beneficiary designations to ensure that your money is passing according to your wishes. Also, be aware of and plan for changing family dynamics. Did a family member who is a beneficiary on your account pass away this year? Did you want to alter beneficiaries but your family dynamics have changed? Be sure to reach out to your advisor to update them on your situation and discuss best practices. The example I always give is regarding an ex-spouse inheriting your assets, which is a devastating misstep and not unheard of. And here's a timely planning tip that's tangentially related. In late 2019, Congress passed the Secure Act, which eliminated the stretch option on distributions from inherited retirement accounts. Under the new rules, most non-spouse beneficiaries are required to fully distribute inherited account balances by the end of the 10th year following the account owner when the account owner dies. Conducting annual beneficiary reviews is a great way to identify clients whose estate plans have been impacted by this change, and it may prompt discussions with clients and their heirs around efficient wealth transfer strategies. For example, utilizing a charitable remainder trust to replicate the benefits of the now defunct Stretch IRA. Now let's discuss some estate planning considerations. So the lifetime exemption is set to increase to $15 million per person in 2026, and it's permanently indexed to inflation. That change eases the urgency around making large gifts before the end of 2025 because families no longer face a use it or lose it deadline. Instead, this is a good time to review your overall estate plan. Outdated wills and trusts may not reflect today's laws. Consider whether annual exclusion gifts, which are $19,000 per recipient in 2025, may make sense to reduce your taxable estate gradually. Also, keep in mind that direct payments for tuition or medical expenses remain an underused tool that can move assets out of your estate without affecting your estate tax exemption amount. It's also important to remember that federal rules aren't the whole story. States like New York impose their own estate taxes, often with significantly lower exemption threshold. As a result, thoughtful and proactive planning remains critical to address both federal and state level implications effectively. Another consideration is balancing capital gains and estate taxes. When deciding whether to gift assets during life or hold them until death, it's essential to consider the trade-off between income and estate taxes. Under the new law, the step up in cost basis remains intact. This means that any unrealized capital gains on assets held until death are eliminated when passed to heirs. The cost basis of inherited assets resets the market value at the time of death, so if heirs sell immediately, no capital gains tax is due. By contrast, giving assets during life transfers the donor's original cost basis to the recipient. The asset has appreciated significantly, the recipient may face substantial capital gains tax upon sale. This means timing and asset selection is critical when planning lifetime gifts versus leaving inheritance. In this practice, this means families should weigh their estate size and the projected appreciation of their assets against the new permanent exemption amount. For some whose assets far exceed the exemption amount, gifting can help reduce future estate taxes. For others, retaining assets until death may be more tax efficient for heirs due to the step up in cost basis benefit if the assets are highly appreciated. Now, here's a planning tip for property owners in New York City on mitigating their estate taxes. So the win in the New York City mayoral race by Zohran Mamdani, the 34-year-old socialist and anti-Israel activist, has caused investors to be concerned about the values of New York City real estate over the next 4 years. While many may be confident in the city's long-term real estate growth, the Mamdani victory may temporarily drive prices down given his socialist talking points. While Comrade Mamdani's ability to implement most of these plans requires legislative approval, the effort to work towards these economically unfavorable plans may be enough to drive real estate prices down. The silver lining for New York City property owners is you may want to consider moving these assets out of your estate at lower valuations. New York State's estate tax exemption is $7.16 million in 2025 and it's expected to adjust slightly higher in 2026. Remember, there's no portability between spouses, which means couples must plan proactively to shield up to $14.32 million combined. Also, keep in mind the cliff threshold, which is when an estate exceeds the exemption amount by more than 5%, then the entire estate becomes taxable, not just the excess. This can result in a steep tax liability. I advise folks with real estate holdings in New York City to now meet with their estate planning attorney to discuss how they can now strategically utilize the lower valuations to save them and their heirs from paying estate taxes in the future. This is also an opportune time to evaluate your estate planning strategy in light of the interest rate environment, which may impact the effectiveness of certain wealth transfer techniques. I'm just going to discuss several strategies that may have impacted planning. First, there's the intra-family loans. When structured properly, intra-family loans offer a way to transfer wealth by allowing assets to appreciate above the IRS-mandated applicable federal rates, or AFRs. Because commercial lending rates are generally higher than AFRs, these loans remain a sensible option in many situations. The AFRs set the minimum interest rate required to avoid classification as a taxable gift. A loan with little or no interest can still be deemed a gift by the IRS. Remember, AFRs can vary based on loan terms. With 30-year fixed mortgage rates currently around 6.2% or something in that area, intra-family loans using lower AFRs remain an attractive strategy, while higher AFRs increase the required interest on these in transactions, reducing the spread between the loan rate and the growth rate. These arrangements can still deliver meaningful estate tax benefits, particularly for families with reliable income producing assets. When paired with the newly increased lifetime exemption thresholds under OBBA, these loans remain a tax efficient way to shift wealth across generations. Another consideration is grantor retained annuity trust or GRATs. From a wealth transfer perspective, GRATs become less efficient in a high interest rate environment. Their success depends on the trust assets outperforming the Section 7520 rate, which serves as which serves as the minimum threshold for gift tax-free appreciation. As rates fall, however, this hurdle becomes easier to clear, increasing the tax-free value that can be transferred. Speaking of GRATs, here's a timely planning tip. In this changing interest rate environment, consider refinancing GRATs when the Section 7520 rate decreases, which has done over the past few months. Refinancing an existing GRAT can improve the efficiency of wealth transfer by lowering the hurdle rate the trust assets must exceed to produce a tax-free gift. By rolling the remaining GRAT assets into a new GRAT structure under the lower rates, the grantor may capture additional appreciation for beneficiaries with reduced gift tax exposure. Now for some year-end trust administrative items. Investors may wish to review the administration of any trust of which they're a grantor, beneficiary, or trustee in a few ways. First, sending crummy notices. In some cases, an individual may design an irrevocable trust, like an irrevocable life insurance trust, so that one or more of the beneficiaries has the power to withdraw some or all of each contribution made to the trust. To the extent that a beneficiary can withdraw a contribution to this type of trust, the contribution is a gift. The contribution is a gift to the beneficiary and qualifies for gift tax annual exclusion. When an individual makes a contribution to the trust agreement may require the trustee to provide notices to the beneficiaries who can withdraw some or all of the contribution. Even if the trust agreement doesn't require the trustee to send those notices, it may be advantageous to do so to ensure the contribution qualifies for the gift tax annual exclusion. Next is making year-end contributions from non-grantor trusts before December 31st. A grantor beneficiary of a non-grantor trust might ask the trustee to consider distributing the trust income to beneficiaries who are taxed at lower rates than the trust. This may be more tax efficient because trusts are subject to the compressed income tax brackets and a lower threshold for the 3.8% net investment income tax. On that point, here's a planning tip. Under the 65-day rule, the trustee may make distributions within the first 65 days of 2026 for tax purposes, treated as being made on December 31st, 2025. This gives the trustees some extra time to evaluate whether to make a distribution. Of course, the trustee should consider the tax status, the goals, objectives of the trust and beneficiaries before making any tax-motivated distributions to the beneficiaries. Next, let's shift gears and go back to investing. Well, this is not necessarily year-end related. It is very relevant based on where we are in the interest rate cycle and should have a profound impact on portfolios in the coming years. So the benchmark rate was cut twice this year and is now at a target rate of 3.75 to 4%. During every falling interest rate environment, I've noticed investors making the same mistakes in an effort to get higher yields but end up increasing risk within their portfolios. If advisors anticipate these common missteps, they will be well equipped to help guide their clients through this part of the cycle and keep them on track financially. Let's go through some of these. First is reaching for yield. Over the past few years, investors have enjoyed putting their cash in money market funds and collecting attractive yields with virtually no risk. However, as rates come down, these risk-free rates will also fall. While searching for higher yielding investments, investors may subject this money to volatility and possibility of losing principal. Next is the mistake of pursuing lower credit quality. Investors may be enticed by lower quality credit to maintain a certain yield within their fixed income allocation. Unfortunately, that means investing in companies with shakier balance sheets. This may be fine for a small portion of one's portfolio. However, substituting most of your fixed income to obtain a higher yield is ill-advised. If you want higher yields in a low interest rate environment, you need to be willing to take more risk with your capital. It's important to keep in mind that the ultimate role of high quality bonds in one's portfolio is to serve as a ballast against more volatile equity positions. Once you invest in lower quality companies, those diversification benefits and the margin of safety are gone. And the third mistake is extending duration. An- Another way for investors to maintain a targeted yield within their portfolios is by extending the duration on their fixed income holdings. In other words, instead of going out 1 or 2 years on the yield curve, they instead go out 1 to 2 decades or longer. The challenge is that duration is a measure of bonds' price sensitivity to interest rate changes expressed in years. Therefore, a bond with a higher duration is more sensitive to interest rate fluctuations. Its price will change more significantly for a given change in interest rates than the price of a lower duration bond. For example, a bond with a 10-year duration is expected to lose approximately 10% of its value if interest rates rise by 1%, whereas a short duration bond would be expected to lose only about 1% of its value. Granted, we are in a falling rate environment, but any unexpected change to interest rate policy can leave bond investments just as volatile as equities without the upside that equities provide. And here's a planning tip to consider, which is a reminder to stay focused on your goals or your client's goals. Neither the Fed nor movements in interest rates should be the key driver to your client's ability to reach their objectives. The ultimate determinant of financial success is having a plan and sticking with it through all market cycles, which is far more important than any tactical moves related to interest rates. And this brings us to a related point, which is where to best allocate your cash now that rates are falling. Ultimately, when you need the money should determine where to put it. So it's imperative to understand your time horizon on your various pools of asset. For example, cash equivalents. As I mentioned, an emergency fund of 3 to 6 months worth of expense money should stay in cash. Suitable cash investments for this bucket are money market funds, maybe CDs, and perhaps T bills. Even as rates continue to drop, you don't want to risk short term funds in other investments. The key is having liquidity when you need it. Next are bonds, which typically offer lower returns than stocks, but higher returns than cash equivalents. Bonds are useful in achieving intermediate goals since they help diversify a portfolio and reduce intermediate risk. If you have a goal that is less than 10 years down the road, bonds should be a component of your investment strategy. And finally, there are stocks, which are the ultimate investment for long term portfolio growth. If you want your portfolio to grow over the long term and outpace inflation, stocks should be a significant portion of your holdings. Any investor with a 10-year plus time horizon is doing themselves a major disservice if they don't own enough stocks. And here's a planning tip, which is asking yourself, what am I looking to accomplish with my money? Your answer will determine when you need your money and will then lead you to the correct decision on where you should allocate it. Next topic is 529 contributions. A 529 is a tax advantage college savings account that may provide an opportunity for intermediate tax savings if you live in one of the 30 states or more, offering full or partial deduction for your contributions to the home state 529 plan. Most states require you to invest in the in-state plan to receive a deduction for your contributions, though there are several states that are considered tax parity states, meaning you can use any state's 529 plan to receive the deduction. One strategy to consider before year end is super funding 529 accounts. Here you can spread a tax-free gift to a 529 account over 5 years for gift tax purposes. So a married couple not making any other gifts to the beneficiary during the 5 year period can contribute up to $190,000 to a 529 plan for each child. And with the IRS 709 form 5 year averaging election, you do not run into gift tax problems. The strategy allows you to avoid using your lifetime gift tax exemption. It reduces your taxable estate, and the earnings growth is tax free if it's used for qualified higher education expenses. Now for a planning tip, which is 529 assets are not currently factored in as assets for the purpose of determining federal financial aid under the FAFSA process if held by grandparents opposed to parents where they are considered. This may be a wonderful way for grandparents to save their grandkids higher education without jeopardizing their ability to qualify for financial aid. The next idea is tax loss harvesting, which is the process of selling securities at a loss to offset capital gains tax liability before year end. When reviewing portfolios with your clients, advisors should determine if there are opportunities to strategically generate losses to offset other gains. For example, Using a tax swap strategy for mutual fund holdings allows you to realize a tax loss while retaining essential equivalent market exposure. The key is that the funds are not substantially identical. The way around that is by using different fund families to track different indices and may have a slightly different strategy, but that still have similar results. A common example is swapping an S&P 500 fund at one company and buying a total U.S. market fund at another fund family. No, the S&P is up this year, but that's the concept that you would consider for different asset classes. And here's a planning tip. One creative approach to tax loss harvesting is to donate cash proceeds from the sale of stocks that are at a loss. In this strategy, investors benefit from recognizing a loss by selling a stock that went down in value. The loss can be used to offset any capital gains for the year, or it can be used to offset up to $3,000 of your ordinary income. That is in addition to the charitable deduction you may receive for the cash donation from the proceeds of the sale. Okay, next ideas regarding employer retirement plans. Here are a few items to keep in mind. First, assess contributions made this year. You should review how much money you contributed to your employer retirement plan this year. If you're financially able to, max out your 401k or 403b if you have not done so already. In 2025, those limits are $23,500 before any company match, or $31,000 if you're 50 and older. And if you're 60 to 63, you could contribute $11,250 instead of just the additional $7,500 just to make things adequately complicated. Also, be mindful of next year's contribution limits for 2026. The contribution limit for someone under 50 is 24,500. For folks over 50, they can contribute an additional 8 grand, up to 32,500. And for individuals that are ages 60 to 63, the cash-out contribution limit is 11,250 instead of the $8,000, which brings their max contribution to 35,750. Don't forget to make the required tweaks within your plan to ensure that you are making the maximum contribution for the coming year. Next is a classic deliberation between a Roth versus traditional. The rule of thumb is if you think that you may have a high income year, then a traditional IRA makes more sense. If you anticipate a low income year, then a Roth IRA makes sense. Regardless, the key is that you're saving money, but if you want to get in the weeds about it, you could decide whether a Roth or traditional makes sense given your current situation. Also, review your investment lineup and portfolio. Determine with your advisor if it makes sense to make any changes. And this is especially applicable if your firm switched 401k providers recently, if you rolled over an old 401k into your IRA, or if you're approaching retirement. In any of these scenarios, tweaking your investments may make sense. And here's a planning tip. Consider consolidating old accounts. If you have old retirement accounts held at previous employers, be sure to consolidate them into an IRA to keep your assets organized. It rarely makes sense to have retirement accounts scattered at various institutions, especially old employers. If you need help consolidating old accounts, feel free to reach out directly to me and I can help you. Next, consider maxing out your health savings account or HSA, which allows you to save and pay for qualified medical expenses with tax-free dollars. In order to contribute to an HSA, traditionally you had to be enrolled in an HSA-eligible health plan. You could only contribute a certain amount to your HSA each year, but all contributions roll over year to year. In 2025, you can contribute up to $4,300 for yourself and $8,550 for family coverage. And for folks who are 55 or older, can contribute an additional $1,000 per eligible spouse, up to the total amount per married couple of $10,550. It's important to note that the eligibility for health savings accounts will expand in 2026. The new tax bill expands eligibility to people who use independent insurance through the Affordable Care Act or ACA and opt for either the bronze or catastrophic level of coverage. The bill also opens HSAs to people with subscription-style primary care services in which they pay an annual fee rather than a per-visit fee to see their doctor. The open enrollment period for insurance through ASA is currently underway and ends January 15th. A planning tip with HSAs is to let the funds accumulate and grow by investing them aggressively while you're younger when your medical bills may be lower. Once you are in retirement and your medical bills go up, you will have a substantial HSA account that can be used to pay your higher medical expenses. Next, if your clients have employer-sponsored benefits, they may have access to a flexible spending account or FSA. FSAs allow you to contribute pre-tax money up to a certain amount to an account that can be used to pay for eligible out-of-pocket healthcare expenses or eligible dependent care services such as childcare. Here's a planning tip. FSA funds are use it or lose it, meaning you generally can't roll the full amount into the next calendar year. To avoid losing any unspent funds, make a plan to use the money before December 31st. Now let's turn to budgeting expense goals for the coming year. It's always essential for investors to assess their expenses and plan ahead for the future. One thing to consider is cash flow management for retirees. This is especially important since retirees must evaluate how much cash they will need in the year ahead to live on and should work with their advisor to ensure they're able to meet those needs. Next consideration is mitigating sequence of returns risk. Retirees should target a higher cash cushion than what is typically recommended for non-retirees in order to sufficiently mitigate the risk of experiencing lower or negative returns early in retirement when withdrawals are being made from an investment portfolio. The order of the sequence of investment returns can significantly impact your portfolio's overall value and consequently your ability to maintain your lifestyle later in retirement. Here's a budgeting planning tip. For clients that are in the decumulation stage of retirement planning and drawing down their portfolio, the amount of money they need may have increased while many financial advisors use 4% as the annual safe withdrawal rate. It's worth reassessing these numbers every year based on personal circumstances, market performance, and the economic environment to see if anything has changed. They're almost finished. Now let's discuss income tax planning. In general, year-end income tax planning involves trying to accelerate deductions and defer income while being sure to take advantage of lower marginal tax rates and avoid income bunching in future years. A good starting point is using your income and deduction information from your last return and adjusting for anything you know about the current year, such as changes in income, tax rates, potential deductions, and so on. Then calculate what your tax will be based on those conditions. The more you know about your current year's finances, the more accurate the projection will be. That's why it's important to wait until later in the year, like we are now, to run the projection. And here's a planning tip to consider. Effective for 2025, the maximum deduction you can claim on your federal tax return for state and local taxes or SALT has been bumped to $40,000 from $10,000 for both single and joint filers who earn $500,000 or less. For those with income above $500,000, the deduction will be reduced by 30% of the amount income in excess of $500,000, and the cap falls back to $10,000 once income hits 600 grand. If your income is in or above the phase-out range, consider ways you can defer income into 2026 to qualify for a higher SALT cap this year. Folks with the most flexibility with this type of planning are people who have control over the timing of their income, like a business owner. Next is the always exciting alternative minimum income tax, or AMT, which impacts more taxpayers in 2025 due to changes under the OBBA. Those earning $400,000 to $600,000 or exercising incentive stock options are at most risk. Under both systems, AMT requires calculating taxes and paying the higher amount. For 2025, the exemption is $137,000 for joint filers and $88,100 for singles. It begins phasing out once income reaches $1,252,700 for couples and $626,350 for singles, numbers that are easy to remember. Next year, exemptions phase out faster during $1 million for a couple and $500,000 for singles, with a 50% annual reduction, which is up from 25% in 2025. The SALT cap increases also and heightens exposure. And here's a planning tip to consider to minimize AMT. Consider accelerating income or adjusting deductions, in particular for folks who hold stock options. They should exercise cautiously, splitting activity across tax years. Another year-end planning tip is for families who created a private foundation. Before year-end, foundations must make qualifying distributions of at least 5% of the foundation's assets each year. In general, distributions include grants to public charities and administration expenses, but do not include investment management fees. The failure to make required annual 5% distributions results in excise taxes on the shortfall. And here's a practical planning tip, which is that a private foundation's investment should be structured to balance this 5% distribution requirement and various other objectives. Consider utilizing a bond tent to factor in these distributions every year and pairing it with other investments for the necessary growth to achieve its goals. And again, if you need help structuring this, feel free to reach out. Now, one final year-end idea, which is to buy my book. This is my first book, and I would love your support as well as your feedback. The book is called D's for Diversification, the ABCs of Personal Finance, and it's geared towards introducing toddlers to personal finance one letter at a time. Each page pairs a financial concept with a vibrant illustration. This would be a wonderful holiday gift for family, friends, and clients. Buy one for yourself and then a copy or 10 for everyone else in your family with young children. You can buy it on Amazon or by going to jonathanonmoney.com. And that concludes today's program. Should you have any follow-up questions, you can reach out to me at jonathan@parkbridgewealth.com. Email's generally the best way to get a hold of me. Three more quick items before I let you go today. First, my fall webinar series continues on Thursday, December 18th, featuring K. Eli Yakovan from the law firm Grant, Herman, Schwartz, and Klinger based in New York City. And Eli's going to be speaking on the topic of asset protection and personal guarantees. I'll be sure to send out the invitation to this program in the coming days. Second, you can follow all my work on X and Instagram at Jonathan on Money. And by connecting with me on LinkedIn, you can also listen to my weekly podcast called Jonathan on Money. And you can watch my practical planning videos, which I post several times a week, by following me on YouTube at Jonathan on Money as well. And third, please take 30 seconds to fill out my survey at the end of this program. It helps me improve my webinars and provide timely and interesting content to attendees. I thank you in advance for that. And with that, this concludes today's session. Please stay safe and healthy and have a wonderful day, everybody.